This is a video about red-green twin peaks, and I've got a couple of examples in Facebook that I'm going to show you. The red-green twin peak comes in a 1-day or a 2-day pattern. Zip red goes up typically at 100 or near 100, and then 1 or 2 days later the green zip green comes up to 100. They're not all near 100, but oftentimes that's what you see. Again, the zip green tracks trades in and out of the market, tracks buyers basically, and zip red is probably the fastest moving indicator in the system, and it is a leading indicator. And the pattern always has zip red first. It's not the other way around. It's this pattern, the zip red, the red green twin peak is a reversal pattern down, and the red green twin bottom is a reversal pattern up. They both come in 1 and 2 day spreads, peak spreads or spike spreads. The example that I have here, there are 3 vertical lines. I'm in Facebook right around the first of the year. This is January of 2016, and Facebook at this time is around $100 or a little bit more, and this first one that I'm going to talk about is a 1-day red-green pattern, and just as a comparison, looking at all 3 of them, we see that this one, the first 2 drop in price, the next one goes up in price. And I specifically chose this so that you could get an idea of how to effectively read the red-green pattern. Now, this one on the right has a red candle. The other 2 have green candles. And typically, generally speaking, the red-green twin peak has a red candle. So if you're getting zip green at 100, which this one is, and you're getting a red candle, the market pressure has already started to go down, and so that's usually a good indication. In this case here, it didn't quite do as well because we had issues with the 100 moving average, the long white dashed line, and the 200 moving average, the tan line. They were bouncing back and forth in there, and the next day we get basically a doji candle with a real long lower tail. So not exactly. And then when it started up, it basically, or the second day, it started basically where it left off, and then finally went down and stayed down. So you captured most of your profit by hanging on to it for 2 days. Now, and at the end of the 2 days, you had a nice red spike. Excuse me, a red spike, and then you had a gap up. In this middle one, we have a 2-day red-green peak, red-green twin peak, followed by a 2nd day of zip green at 100. And the reason it stayed as 100 is because the day after this red vertical line here in the middle, the stock gapped up and then went down. It gapped up to 107.49, or opened at 107.49, went up to 75, so it went up about 25 cents, and then started to go down and went down a couple of days nicely. And the third one we're going to look at and compare is over on the left. That one has zip green at 100, and 2 days before that we had zip red at 98. and we had a significant rise in price when that happened, as we typically see in all three of them. The difference between these three, however, the one on the left, swing gray, is in a high cycle. Now high just means that it's above zero. Swing gray low cycle means it's under zero. But it's been climbing for a couple of weeks now, and the swing gray is at 5.1, so that's fairly strong. It's getting into that strong range. It can go much higher into that 12 or 15 range, but doesn't go over 10 a whole lot. Now, again, one of the things that we see here in this on the one on the left is that the short-term trend lines, the power green and orange, are well above zero going up. Swing red and green, again above zero going up. And we have a significant amount of let's see, market pressure. And I say that because if you look at these two lines here on the right, look at where your lines are above the power orange and green lines. Actually, your orange and green are under zero over here, which is much better, near zero here. But this one on the left, it has power yellow way up there. Power pink is also real high, and pink and blue are separated significantly, which is typical of more activity, price activity. And if we switch over to the other chart that shows the price chart and the trend chart, so that you can see all five of them, there's not a whole lot of difference on the trend chart. Red happens to be highest here, trend red, but it's real close to gray. Gray is highest here, and red is on a low angle low angle up peak. So typically that would say it's going down next day. And if we check here, the close on the red vertical line over here was at 103.77, and the next day it was at 103.70. So it did go down 7 cents. The trend red went down to kind of start its downtrend, but you can verify your trend going down by the price green and red lines. If you look over here, you can see that they go down quickly, indicating price. Now, obviously this one here had that doji in the middle, so it had a notch up, but the two red and green lines over on the left vertical line over here, they stayed up high in that 130, 140 range, and that's typically the peak. I very seldom see either of these lines at 150. They pretty much cap out at around in the high 140s. And so there's a lot of separation between the green and red versus the price blue line. They're just real high, and when they are real high, then the price goes up. So you would have been able to see this, and definitely after the next day, after this red vertical line, you would have seen that there wasn't any downtrend activity going on as far as the price was concerned. You've got a little bit of movement in the candles there, and of course you've got some movement in the other narrow lines on your zip chart and in your power chart. But zip pink is still climbing up, even though your zip yellow is above it, as green continues on for about 4 days at 100. So these three examples of the red-green twin peak are a little bit different, but they give you, this one was a 1-day red-green peak, this one was a 2-day red-green peak, and this one was a 2-day red-green peak. But notice the difference between where the lines are on this one here on the right. Your lines are down under zero or near zero. They're not very high above the red, above the orange and green power lines. And the power green and orange are right in there with the lines, with the narrow lines just slightly above it. Whereas this one over here, your power yellow, pink, and blue are just sky high in relation to what's happening on the vertical, on the two examples on the right. So keep all of your lines in mind. I mean, there's more to what's in these lines than you first think and look at them. There's a lot of information, and height above zero in the power chart is a classic example here in these three comparisons. All three of them are at 100. Your peaks are right next, 98 and 100. And so there's no difference in the zip chart on where your red-green peaks are, but your other charts will tell you stuff. There's, on these two on the right, there's no high cycle going on in the swing gray. It's just not there. And so the indicators will tell you and give you a lot of information. We right here in this middle one on the price chart, for example, you have a BOC higher pattern. That's on a peak. That's a divergent condition. When that happens, it's almost always the next day down. And so the following open, you're getting prepared, and what does it do? It gaps up nicely, and that's kind of what you want, because you just wait for the peak to hit and then buy in and short. And so before you even went to the open that day on this middle line, there was an extreme high probability that it was going down. And on this first one, we already have gone down. We're in a TOC pattern, and so we're expecting a continuance of that pattern. And it gaps up a little and then kind of goes down and then comes back up on this second day and gives us a little notch up pattern. But the second day it drops down again. And as I mentioned to you before, it's not the case in the price red and green over here on the left. They stay up high in that 130, 140 range. And when they stay up high, then no price reduction is occurring. The price values are pretty much the same. So, and the other thing too, notice where your trend trio lines are. In the middle here, they're under zero. On this one over here, they're under zero. But up here, trend blue is actually pretty high. Trend blue is at 25. And it takes a fair amount to bring it down, because the trend trio lines are slow moving lines, so that it's not going to be a quick thing typically. So there's just a lot of information that you can pick up with the 7 short-term trend lines and the other information in the 5 charts. So use the indicators to your advantage. Learn what's happening. Read the information. The system is built to show you how it works by way of examples. These videos are the best methods that we have to help you identify how indicators work, because there's 22 market force recognition indicators that are very sensitive and very powerful to pick up the next day movements when only tiny market force pressures are there. And that's what we pick up before the big move, price move takes place. And that's what you want to be. You want to get into those positions before those big price moves takes place, because they're going to happen 1, 2, 3 days, 4 days out. So the red-green twin peak is another reversal pattern, price down, and we at Day Trading Visual Basics are excited about it. So we hope you are too.